All right, so no teams this week. We might do 2 questions next week. The options is the big thing that we're going to start covering. I might do the beta and KE question as well, because we haven't really seen that one. So I want to finish up the paper 3 and 4 discussion real quickly and then get real quick in portfolio manager. Man, really got to get to derivatives as quickly as possible. So if you go into Capital IQ and you just tell it to dump all financials, slide the years, you get all the years. They'll give you this massive file, which is really impressive. You just say, bring in all financials. And the 2 pages you'd want to use are the income statement and the ratios. So this takes them back to 1979. And so if you do that and want to look at certain growth rates, can certainly do that, although you may get some crazy numbers. So I at least want to just know what they've done last 3, 5, and 10-year CAGRs. So CAGR is a number you're going to do a lot. A CAGR is just a compound annual growth rate. We do CAGRs a lot because our minds think in annual terms. So you can certainly do it on revenues. So a CAGR is just the ending value over the beginning value raised to the 1 divided by the number of growth periods, not number of years, but number of growth periods minus 1. So if you're looking for a 10-year growth rate, you take this year's number and divide it not by 10 years ago, but by 11 years ago, because you have to have 10 growth periods. So for revenue for 3 years, you have the ending revenue number divided by not 1, 2, 3, but 1, 2, 3, 4, raised to 1 divided by 3 minus 1. I'm always thinking inflation. Inflation's been high the last couple of years, so it kind of distorts things, but inflation at 2, 3, 4, 5% range. You can see they've had some pretty good revenue growth the last 3 years. The last 5 years. How many years I'll go back? How many? 6. 1, 2, 3, 4, 5, 6. Divided by the 1 to the 5th minus 1. So 4.7, still pretty decent revenue growth for a firm as large as they are. And then 10 years, that divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Raised to the 1 divided by 10. So much smaller growth, almost not much better, which it's actually a pretty pathetic growth number. Because what has Walmart been doing during this time? They grew their revenues 3%, but what else have they been doing? They've been adding new stores. If they added 3% more stores, what should that growth rate be? At a minimum, it should be 3% plus inflation, shouldn't it? So you might be interested in how many stores they've added. That's not in this data. You can get that off of Bloomberg. I actually like to look at the growth in their square feet because their store sizes have been changing. But this is a pretty pathetic number. So what has Walmart been facing the last 10 years? Probably Amazon. Yeah, so some pretty good competition. So the 3% is pretty weak, but their recent growth has been much stronger. Now that you have those set up, you can look at any growth of anything. If you want to look at the gross profit, you can see that's been growing at a weaker rate. So that means cost of goods sold has been growing faster than revenue. Operating income growth rate the last 3 years. Look at the last 10 years. Essentially, operating income's been flat. With adding all those stores, their income is not growing. That's pretty pathetic. You can certainly look at their net income. That's actually falling the last 10 years, but grown really strong. What's happened in the last 5 years where you have COVID and some other strange things going on in there? Anything else you want to look at, you can certainly look at dividends. Here's earnings per share. Earnings per share typically grows faster than earnings because of stock buybacks. So that kind of makes sense. You can look at diluted, doesn't make a big difference there. And then dividends per share, you can see how their dividends are not their free cash flow because their dividend growth is much slower than their earnings growth the last few years. In line the last 10, but the last 3 years unrelated. So dividend may not be a good number. So questions on that? So some are asking what if 10 years ago or 11 years ago their earnings was negative? You can't do a CAGR if the earnings were negative. You have to throw it out. What if 10 years or 11 years ago, their earnings were unusually small, like 1 penny? You get a growth rate like 80,000%. Well, don't do a 10-year CAGR, do an 11-year CAGR. If you got an unusual period of time, because 10 years ago, let's say 2008 or something unusual like that, you can't do it. You can do growing growth rates, here on the basic earnings per share, you can just look at it year by year and see if there's any pattern there. I don't know why I did that. Oh, because they don't have earnings back there. So I like to do quick and fast things just to see if there's something going on. Anything I can see, anything you can do quickly. So you certainly see COVID in there. But do you see a trend of Amazon bringing them down, and then COVID just brought them back up, and now they're kind of, I don't know what this last year is going on with them, but there's all different things. So if you're asking what exactly do I do, the answer is you do what makes sense. So y'all see the difference between finance and accounting. And accounting says, take this number, put it here, give it to Bob on Tuesday, take this number, do it here. Tuesday at 3:27, you're going to go do that. That's not finance. Finance is figure it out. Which do you prefer, accounting or finance? I'm glad I started in accounting because I liked having everything spelled out for me every single day, but that got really old after a while. As we say, accounting is like doing laundry, is you keep things the same socks every month. Finance is, my first finance job was figure it out. And how do you figure it out? You figure it out. All right. Fortunately, my first finance job, Lisa was there. So Lisa kind of helped me, like, you should maybe do this or do that. She was really smart and had some good experience. She'd only been in the department for a year, though. It's not like she was there for 20 years or something. And just figured out. I had no job. My job description was make USAA better. It's like, okay, I can do that. My accounting job was every single day. I knew exactly what I was doing. So how do you get the growth rates? It depends on your firm. It depends on how volatile it is. Depends on what kind of numbers. Everything's going to be different in every single firm. If you look at ratios, the key ratio here is return on equity. So the question here is, can I use this last number, or do I need to somehow normalize it? Remember, we're doing sustainable growth is ROE times retention. So if you have an unusually high number in the last year, then you might say, hey, wow, I can't use that number. An unusually low number, you might use the median of the last 5 years, something that can tell you. I don't think with Walmart it's going to make a huge difference. The median 16, the last year was 18. So maybe it's a little bit lower, but some firms are really, really volatile, especially like an Exxon or someone who's really sensitive to a commodity price. The last year is just 1 year out of a bunch of volatile years that may be unusually high or unusually low. So that's about the only number I use there. So questions on that? I like to do this because it gives me some sense of what this firm has done. So if you tell your boss, I think Walmart is going to grow their earnings, 40%. So, wow, they haven't done that. Or you say 15%, say, well, they've done it the last 5 years, but we're probably not going to get another pandemic in the middle of this. So what are you assuming? That would be pretty high. Their long-term growth has barely been even inflation, and that's with them adding all those stores. They're going through a lot of work to barely keep up with inflation. That's pretty pathetic over 10 years. You know, so that's the kind of thing you're trying to justify the number. It doesn't mean you're just going to take their history and extrapolate it to the future. But it's rare for a firm growing 5-6% to suddenly start growing 20% without some strong argument for why they're different. All right, I'll show you a few papers from last semester. They use the 2-column format. A little bit of history on the company, you always do that. Then they talk about the discount rate. You're probably not going to put this kind of stuff in your paper. You can, but what's your boss going to think of that? Yeah. Hey, boss, in case you missed your freshman year of finance, let me inform you how you calculate your discount rate. Probably not going to work in a real paper. I don't care. I don't count off for that, but you're probably not going to do that in actual paper. He put in a graph of the 10-year treasury. He just got it from Fred. You can just get it from Fred. That's perfectly fine. That actually looks good. And a paper that shows that you know how to get data from the Federal Reserve. So there's the risk-free rate. Then he's going to talk about the market risk premium and explain all of that. A little bit more discussion than probably you need to have. Then he's going to talk about their beta, talk about his Google of cyclical or defensive, going to talk about their debt, and then do the historical number. So then they're done with paper 3, and then they get into paper 4. You'll have a section on long-term growth, which will probably tie back to paper 3 because you need that number to get your market risk premium. Here they did their CAGR over the last 10 years. I think this is the 10-year CAGR over the last 10 years, which you can certainly do. Certainly shows their growth is slowing, which you expect. It's really hard for a firm to grow 20-30%, especially once you become a $100 billion, $200 billion company. And they make that point. It has slowed. And then they do the PEG ratio and all those approaches. And then you can ignore all those approaches, the PEG, history, sustainable growth, and say, but I'm going to use this number. So the right number is what you think. So I've had students email me, how do I get the growth number for my firm? It's like, whatever your crystal ball tells you, that's what the number is. It's a forecast. It's your forecast. It's not somebody else's forecast. Otherwise, your boss doesn't need to pay you anything. You'll use other people's numbers. You got to come up with your own numbers. You have to have some justification for that. So he's giving some justification, right? You got to come up with that H. If you have a firm that's heavily influenced by AI, like I was talking about with Duolingo, you can certainly use that in your argument. Find some way to come up with that. One thing I strongly recommend in your paper that you wouldn't maybe do this in a real paper, but it really helps me if you put the formula in there. Because some students come up with answers that just make no sense to me at all. Sometimes it's because they put the parentheses in the wrong place. And I want to know that because that way I can tell you is like, wow, you're really calculating that wrong. You may want to look into that before you do exam 2 because you're putting the wrong parentheses in the wrong place, or especially on the H model. I've had some students, they do this and then they do that. So it's this without dividing by that plus this, and they get a really weird number. And I want them to know that for exam 2, so they know that they've got a math error. Come up with the valuation, and then finally a buy or a sell at the very end. There's a second paper, very similar. Duke Energy, they put a little bit of description of the company up here. If you're doing a utility, really, really critically important for utility is where are you? Utility is a very location. You don't sell electricity in all 50 states. Is that going to influence your growth rate, do you think? If you're selling electricity in New York or California, is that going to be different than selling electricity in Texas or Florida with all these baby boomers moving to the south? Yeah, that's going to have a huge impact. So what states are you in? So it makes sense that they would have started with what states is. And Duke's kind of one of the largest. I don't think it's as large as, let's say, Nextera or something, but they're very large, but very landlocked. And utilities don't usually move in the other states. These are, there are some mergers and that, but they tend to stay where they are. Same type of thing, talk about your risk-free rate, your market risk premium. You'll see those similar charts, right? That everybody else is showing, and the beta. You're going to see these charts in your paper, which makes a lot of sense. And then you'll do your historical beta. I don't like having the months in there. Remember, you want to put that low on the axis so it doesn't overflow, because sometimes a Duke can have a negative beta. If a negative number, you want to change your title to be low on the chart so you don't get that, but I would change that to years. Then this table makes a lot of sense, right? That way you make sure you get full credit for all 4 steps. So that makes a lot of sense. He did it very, very clean. Or she did it really clean. And then long-term growth. Here, she did actually a really, really good job of talking about population growth in those particular states. So she had something to work with, right? That gave her some argument. Maybe that's why she picked Duke. So, hey, if I pick Duke, I got something to talk about short-term growth on. So, yeah, so that's really good that she found that. Demographics is one of the best things we have. We're horrible forecasters, but we have a pretty good idea of how many 50-year-olds men there are going to be in 10 years. We're pretty good at that. Life insurance actuaries are pretty good at predicting when people are going to, even with COVID, yeah, that changed things, but not radically. Even with fentanyl, that's changed things, but it's not radically. It's not like we're expecting, 40% fewer 50-year-old men than we thought before. It's not that radical. So she's population growth is one thing we're fairly decent at forecasting. So gave her something pretty concrete to work with. So there's a short-term growth. So you have some growth rates here. It didn't work too well here. So not a very good chart. Something like this, you probably be better off with a table. Not everything works well as a line chart. You got really lumpy numbers. Sometimes just putting stuff as a table works better. So you probably would have been better off on that. Then she has a whole discussion on the H. You don't need inflation in this paper. We're not doing the capitalized earnings model in here. So some of these are a little different. And then her finally, now she did a data table. You can certainly do that where she ran multiple scenarios. That certainly works. Looks like she probably would put a buy recommendation because there's a lot of green in here. Here's another one. Exxon, boy, I wouldn't do Exxon right now. Pretty tough firm to forecast. I mean, it's oil and it's natural gas. They're trying to do other stuff, but it so pales in comparison to oil and natural gas. Now, a few years ago, they really went somewhat heavy on natural gas. Natural gas prices were just dormant, and then Putin helped a lot by attacking, and so that oil natural gas prices suddenly shot up from $2 to $6. Those are really hard things to forecast. We're talking about EVs, and now EV cells aren't working, all this kind of stuff. So mobile is a really, really difficult. It's also a, it's not downstream or upstream, it's everything. So you got the refiner, they're also, they do everything. So it's a tough firm. So they took something pretty tough to forecast, but very similar. You can see very similar stuff. Use my titles, revenue sensitivity, operating leverage, the historical again. I wouldn't leave the months in there. That just looks strange. Change it just to years. And then put the table in, which I like a lot. Now they did the market risk premium after beta. That doesn't make sense to me. I would do risk-free rate and market risk premium, then the beta. I mean, I didn't count off for that, but that's just a little strange. Again, the growth numbers, you would expect Exxon to look like that because they're so sensitive to oil prices. So what would be more interesting here would be to do CAGRs and do it against oil prices just to show that, hey, when oil prices are down, their earnings are down. When oil prices are up, their earnings are up. So I might do that, or even do a correlation of their earnings, because when you have Exxon, what you're going to discover, which makes it so difficult, to do a good forecast for Exxon, you have to have a good forecast for oil prices. Who has a good forecast for oil prices? Nobody. Now you can go out and get forecasts of oil production, oil use, there are sites out there that do actually forecast out what we think oil usage will be over the next several years. You can certainly do that. So you can see picking your firm, given that short-term growth and age are your two hardest things, you can pick firms that will be easier because they have things to work with. So went through everything. Final recommendation. Exxon is one of the firms that is on business breakdowns. So I don't know if y'all listen, I would highly recommend them. This can give you some great ammunition to help justify growth rates and talk about the firm. So I wasn't familiar with this firm. I thought this was a really interesting firm. They own Plato's Closet, which I've never heard of. Played Against Sports. I don't know any of those things, but really interesting firm. And they start off this podcast apologizing that they're interviewing the CEO and not interviewing an investor. I actually like these better when they interview the CEO. One of my favorites is Cinnabon. They interviewed Kat Cole, and I thought her interview was better than an investor interview would have been. It was a really good interview. So I like it when they interview the CEO. Obviously, it's very biased, gives you a slant toward positive for the firm, but really interesting. But these have all been really good. I would not do Boeing for your firm. Don't do an international fund firm. But here's one, Intuitive Surgical. So you're talking about robotics. That gives you a lot to talk about with the age and short-term growth. I don't think robotics is actually as good as people say it is. I think it's a bit overdone hype, but it certainly gives you something to talk about. You want to see one more, maybe? Let's see. So Target, some of you are doing Target. Introduction, discount rate, risk-free rate, same type of thing. You see a graph, market risk premium. You see those charts again. Discussion of the economic growth, which you can bring into your paper 4. Beta, revenue sensitivity. Target's a little tough because it's a discount store, but it's a high price discount store, which I forget what is Target's saying. Buy less, pay more. What is it? It's something like that, but it somehow distinguishes them from Walmart, but I can't remember what it is.
Expect more, pay less.
It's what?
Expect more, pay less.
Expect more, pay less. Okay. So what is Walmart's? Everyday low price, right? We're cheap. Expect more says, okay, we may be a little more expensive than Walmart, but at least you don't have stuff laying in the aisles. You've been to Walmart during like holiday shopping season and go down the Christmas card line. I mean, it's just like garbage everywhere. It's just a mess. All right, so similar type of stuff. Stock valuation, discussion of long-term growth, a whole discussion on the half-life. Now back then they had a little bit of saying, hey, we're still coming out of COVID to help kind of hit their short-term. Target's doing these kind of neighborhood stores that seem to be real popular with millennials and Zens, Gen Zs. I don't know. I've never been in one. I don't know why that would be exciting. I just like Targets because there's no one in them. So I like shopping without a lot of people to compete with. But that can't be good for growth. But I haven't been in one of their neighborhood type of storefronts. So here is some good summary at the end. They have 3 because we have one extra model there that we're not doing in this class. So he recommended a buy, but anyway.
Really build them closer, like I have one close to where I live, actually work at. It's basically just groceries, nothing else. It's much smaller location than the super centers.
Just groceries, really.
Just groceries, none of the appliances or anything.
I've seen the smaller Walmarts. I would assume they have, because they look, they're pretty big. I mean, they're definitely not Dollar Generals.
There's office supplies and some like pet care stuff, but no, it's just groceries.
Yeah, I mean, groceries is something you could just make that's your only It may make some sense. All right, anything else on papers 3 and 4? So picking your company is pretty important because you need to have some opinion. Business breakdowns is exceptional. I really, really like it. If you're not listening to it every week, you really need to. They talk about corporate finance. They talk about valuation. Exactly. The people relating, the guy who's doing that podcast, he's an investor. He knows what he's talking about. He's got a strong family history of doing that. So highly, highly recommend. All right, let's move on to portfolio, just real quickly on portfolio management. So you're going to build a portfolio. My risk management class is working on this right now. I have a charity right now that they want to start doing a portfolio, and I'm telling them you've got to do it because they've got $1, $2, $3 million just sitting in cash doing nothing. It's like, man, we can add a lot of income. So they're asking, how do we do that? So I sent them a draft investment portfolio policy. And I just want to do a cash account. We're not going to do stocks and anything like that. We're just going to be investing in cash. Instead of making 0.2% from a checking account, we're going to be making, 5, 6% off of treasuries and CDs. So they can add $50,000, $100,000 in income. Yeah, it makes a lot of sense. So how much do you need to start a portfolio? If a stock portfolio, you can start pretty small. If you're going to buy ETFs, you can buy one share of a stock, and today it's essentially free because you get a Schwab account. You do need to pick real carefully your broker. So how many of y'all have a brokerage account in here? Are you trading live money or paper money or live money? So yeah, so I love Schwab. I was at USA. They sold off to Schwab. Thanks to Robinhood, now everybody's free, but not everybody. So I was dealing with Frost Bank and asked for their schedule, and I was just shocked that it was like 60 years out of date. It was a horrible, horrible fee. So some banks are that's not their competition. I don't know how Vanguard's brokerage is. Sometimes if you use a brokerage just because that's your investment firm, that may not be a smart way. I did it with USAA, but they were very competitive back then. But Schwab has been wonderful. I have enough money with Schwab that I can do my little charities with them, and they'll let me do those without much because they want to keep me everywhere else. But you got to pick carefully. I would go with the fees. If they're charging commissions, there's no reason to use that. There's just not going to have, there's no reason to pay 10, 15 or like Frost $40 for a trade. It's just ridiculous. And so you get set up $150,000. You can do a portfolio, maybe 50,000. I think once you're down below the 50, you're probably just going to go into mutual funds or exchange traded funds so you can get diversification. It's hard to diversify when you have $50,000 of money, but you can if you just want to test it. Bond portfolios, with the exception of treasuries. So I am buying treasuries for my charities. A lot of them have a minimum of 1,000, but you can do, I do 25,000. Schwab is really good on the bond side and on the brokered CD side. So you can very easily go out and find what you're looking for. I'm doing treasuries now just because they pay more than bank CDs. There's no reason to buy a bank CD. Once you get past treasuries, I don't think you should be buying bonds. You're really going to get ripped off. It's an institutional market. They're trading in $50 million, $100 million blocks. If you're a small investor, you're going to get killed on the bid ask. It's just going to crush you. But treasuries, you can get pretty good deals on treasuries. Municipals, I don't think you should do municipals individually. I think you should do mutual funds on municipals. You're still just going to get crushed. Bonds are not small investor markets. So buy ETFs, buy mutual funds. You're just much better off. You're just going to get so crushed. I still remember a store at USA where they sold a municipal at 92, which is what it was worth. And that broker turned around and sold it to his customers at 100, which means his customers lost 8% in 5 minutes. Just horrible. And why did he do that? Because he made a bundle off the trade, right? He bought it at 92, sold it to his customers at 100. Pretty unethical, pretty shameful. He's saying, well, I did this favor for my customers, but no, he didn't. His customers would have been better off buying a mutual fund from USA, and they would have gotten it at 92 versus at 100. So just be really, really careful. If your uncle's buying municipals, he's probably losing money. He's probably getting crushed, but unless he's got $100 million. So then, that's fine. You hope he's 98 and very sickly, right? Because you're gonna get his inheritance, but more than likely, most people should just buy mutual funds. So if you're gonna be a stock picker, you gotta distinguish between a good company and a good stock. I'm hoping we start this again in Investment Society. Sebastian just did a really good video on stock picking. So a good company has good fundamentals, good growth, good earnings growth, good cash flow growth, good ratios, and looks good on risk, low debt, low betas, stable earnings, high quality management. That's a good company. A good stock is just a cheap stock. So could you have a bad company that's a good stock? Absolutely. A company that's just not growing, Coca-Cola has kind of been there. Coca-Cola is a cash king. They produce a lot of cash, but they're not growing fast. There's times where their stock just looks really cheap because you buy them, you can get this wonderful, wonderful free cash flow. The fact that people aren't drinking sodas the way they used to, it's still a very, very lucrative firm. Because you have a good company that's a bad stock, yeah, that's probably what's going on with tech stocks right now. You saw a big sell-off in growth stocks last week. Maybe Nvidia is too expensive. I don't know if Tesla is still too expensive. They've come down quite a bit. But 40% ago, Tesla was a good company and a bad stock. And now maybe they're becoming a better stock. I think a Costco is a good company. That's a bad stock. I think Costco is just way too expensive, but it's such a wonderful company. I love everything about Costco. Just the way they treat the customers, the way they treat their employees, and how focused they are on one thing, and they're so consistent. I love that, but so does the stock market. And so they pay a lot for that stock. So if you're gonna measure things, you got to figure out what you think is a good company. What do you value? And then how do you put that in the stock price? And you're trying to find a good company that stock is cheap. In the Investment Society, we do that. You can watch my YouTube channels that show you how to do that. So if you're going to be a stock picker, you need 4 things. You need a philosophy. You need a process. You need a construction process. You need a screening process, a construction process, and you need risk management. So your philosophy starts with, I believe. I believe stocks with these characteristics outperform the market. And where do you get that? I would recommend you still first. Before you go into interviews, go still somebody. So what do you think is the most popular philosophy? Probably the most popular one out there is GARP. Anybody know what GARP is? Any guesses? What does the G stand for? Growth. A-R-E. What's P stand for? What are you gonna say? Or someone? Not annual. So that's what do we do? Compound annual growth rate. So it's not CAGR. All right. So P is price. You want growth. What kind of price do you want? Why doesn't it say growth at cheap price? What is the R? Not risk adjusted, but that would be pretty good. Reasonable growth at a reasonable price. If you need a strategy, you need to have them going into an interview. GARP is the easiest. Just pick that. What does GARP mean? I want high quality companies. They're growing fast. They got good management. Their products is selling. They've got a good market growth ahead of them. They have growth, but I don't want to overpay for growth. Right? So that's GARP. Growth at a reasonable price is an equity investment that combines growth and value investing. So what is value investing? You just want cheap stocks. So GARP kind of combines growth and value. High growth firms, but aren't too expensive. Are these things just laying around everywhere so easy to pick up? Wow, this is a great company and it's really cheap. That would be inefficient, right? Markets are pretty efficient. So you're not going to find those easily, but you have to. Now, does everybody believe that? I was in a mutual fund once, and I was listening to the portfolio manager, and he says, all we care about is growth. So I said, well, what if the stock's overpriced? I said, we don't care about that. All we care about is growth. So if the firm's growing fast, we're going to buy it. I don't care how overpriced it is. Does that sound like a good strategy? Guess what I did the next day? Sold all my shares. It's like, I don't like that strategy. He says, all we care about is growth. We're just finding firms. Now, there could be some logic to that because the most you can lose 100%, but you could be up 80, 90,000%. So their philosophy was, we just buy growth. One of those growth companies is going to take over the world and is going to be up 80,000%. So yeah, maybe, but I don't buy that argument. I don't know why anyone would buy a stock that they know is overpriced just because it's growing fast. But that's garbage. So that's probably the most popular, and that's the easiest philosophy that you can have. And since you're saying, I believe firms with good fundamentals, good growth, that have reasonable valuations, reasonable PE ratios will outperform the market. Right? Is that easy to screen for? Growth is easy to screen for. You can look at historical growth. That's easy to do. Earning stability, you can screen on that. Bloomberg has a screening tool, which they may have the standard deviation earnings or something. You can certainly screen on return on invested capital. Can you screen on high quality management? What would you put in your screening model there? That you're gonna have to do independently, right? You're gonna have to interview management, look at them. So that's gonna be a little bit tougher.
You have to look at turnover.
Management turnover, maybe, or employee turnover. If you can get those data, I don't know where you'd actually find that data, but maybe be able to. I mean, Tesla's laying off 10% of their firm. That may, yeah. But high quality management, that's one you're gonna have to do. The quality of the firm, you can look at credit ratings. Bloomberg has something called 5-year probability of default. It's a wonderful number because it's highly correlated to credit ratings and it's a number, so you can do numbers on it. How reliant are they on accruals? I was talking to my P&C in finance class. Insurance companies, especially property and casualty, their actuaries are making these accruals that are can be way off by billions of dollars, and they adjust them, and so you're heavily reliant on that. Valuation, cheap stocks, you can look at technicals if you're in that. You can look at thematic kind of things. You have some philosophy that these stocks you think will outperform market. You could try to back test your philosophy. Back testing is really tough to do. One of the reasons back testing is tough is because of survival bias, especially if you're a value investor. You say, hey, I really love these cheap stocks. And you look back historically, if you've gone back 10 years ago and bought value stocks, well, it wouldn't work 10 years ago, but you say, hey, if I bought these value stocks, they would have outperformed. Well, the problem with that is when you go back 10 years to test it, the companies that went out of business aren't back there. And you might have bought those companies. And value companies tend to go out of business. So you might have just be looking at the value stocks that survived. And so that's called survivor bias. You have to be real careful on that. It's very, very tough to actually go back and back test because when a firm goes out of business, they just disappear from the database. And you might have bought one of those firms. And you can actually look that up. You can actually Google that. Survival bias. You can spell and see how do you actually adjust for that? And it's almost impossible to adjust for that. I mean, the other problem you have is merger and acquisitions. Once two firms merge, the data disappears. You don't know if we would have bought that stock or not. Huh?
So like when bigger companies give out their certain companies, was that valued? How should we get?
Well, for screening, you can use analyst estimates. You can use analyst recommendations. So Bloomberg does have one of the things we have used in the past is percentage of buy versus sell recommendations. You can use that. That's really hard to backtest unless you start collecting the data. So backtesting is just really, really tough. Does that actually work? If 80% are buy and 20% are sell, will that stock beat the market in the next 5 years? I don't know. My guess is probably not, but it might. I would say right now, you just come up with philosophy and go with it. Still somebody's, go find someone. So like GMO, I like GMO. There's this momentum and quality. That's what they go on. And you could read their philosophy. What do they mean by momentum? Momentum just means the stocks that are going up tend to keep going up. That's pretty simple. What do they mean by quality? They don't tell you, but they have an index of quality and they think quality stocks are expensive and cheap at certain times. But those are their two strategies. They say they're uncorrelated. So if momentum's working, quality may or may not be working, but they're kind of give you diversification. Yeah, you need something in an interview that you can talk through that your philosophy on buying stocks and stealing someone else's is perfectly fine to do. Once you have your philosophy, now you got to figure out how do I take that philosophy and I start screening for stocks. Usually you start with the computer. If you're going to use the Russell 3000 index, that's 3,000 stocks. You're not going to be able to analyze 3,000 stocks. But the computer can do that for you, bring in all the data. You probably won't do 3,000 stocks. You'll probably do it by industry or by sector and screen them out. You can, again, watch my videos, shows you how we do it in the investment society. So you need to screen down so you can take 3,000 stocks and try to get to a buy list of say 100 to 200 stocks. So you can do more detailed analysis. Or you can come down, there are some firms that their entire process is computer. They don't have analysts that do things, I used to work with DRI and it was all computers. I was like, what do you guys do the other 29 days of the month? Because they ran the computer once a month. They did all the trades, they did the trades. And I found out what they did. They called their clients and talked to them 3 hours about baseball and other things. Because it was like, oh no, he's calling me. And it's actually kind of fun. One of the guys was he used to play pro baseball. And so, yeah, he would call me. I could just tell he's bored because they didn't have anything to do the rest of the month. But yeah, all computers there are some firms that use computers at all. They're just stock pickers, but they have a really small industry they follow, like real estate stocks or something. And they just know them backwards and forwards. But you need some process. Probably for you, your process is going to be a computer and you should teach yourself how to do a screening. Bloomberg itself has something called EQS. If you type that, it has a screening tool online. I'm sure Schwab has a screening tool. Most brokers have a screening tool that you can use online. So now you have your stocks that you want to buy. How do you buy them? That's portfolio construction. How are you going to actually put them in the portfolio? If you have 100 stocks, you're just going to put 1% in each one. So how do you do it? In the investment society, we did equal weight, which is pretty simple to do. There are some that do fundamental weighting, which is using their earnings or revenue or something to sort that out. Some, like S&P, does market weight. There's something called enhanced indexing, where they try to stay within the market rate within a certain amount. Some, the model tells you how much to put in each stock. There are some that have optimization models where they have, these are usually called factor models. I don't know if y'all have seen factor models. There's many of them out there. We use hedge funds that had factor models. They may have 50 things they're looking at. And one's green, one's red, whatever, and it's showing them. And you hope they're not correlated. So if one's working, one may not be working, and they offset each other. So maybe the most famous one is BARA. So MSCI BARA models, that's a factor model. It used to be, you could go look at it, but it got bought out by MSCI, so you can't actually see it anymore. They used to list all the factors on their website, but they don't do that anymore. But yeah, that's a factor model. You could buy their factor model and use it to pick stocks. What it does is it tells you, it helps you get a discount rate for each stock. So it adjusts for different factors, and then you can use that to help value stocks. They have models all over the place. So you got to decide how you're going to weight. Equal weighting is not bad to do, but if you're going to do equal weighting, then you got to decide how to rebalance. Because if you do equal weighting, they all start at 1%. One's going to do well, and now it's 2%. One's going to do badly, it's 0.5%. There are a lot of papers written on rebalancing. The general answer I've seen is rebalance once a quarter. Why is that? I don't know, but that's what they usually say. Once a quarter, go in and just reconstruct your portfolio. The investment society, what we did is anytime we did a trade, we would use that trade to rebalance, get everything back into shape. But we had certain rules. If a stock got too big or industry got too big, we would we had trades to get everything back in. But you have to decide how you're going to do that. Portfolio construction. So you can't just say, I like these 20 stocks. You got to say, well, how am I going to actually purchase them? How do I decide how much to put in each stock? And then your last thing is your risk management, which is your sell discipline. How do you know when to sell a stock? So the most important one is, how do you admit you made a mistake and you get out of that stock before it crushes you? And that's the worst thing we're at. Because what keeps us from doing this? We bought a stock, it's not a good stock, it's messing up. What keeps us from trading?
That goes back up.
And what's that hope based on? Our egos, what our egos want. We don't want to admit we made a mistake. If you sell it at a loss, you're admitting you made a mistake. If you tell your boss, I was this early, it's still going to come back. And your boss is like, that was 3 years ago. How early were you? Yeah, I mean, it's tough. So the sales discipline says, you know what? I still think this is the right trade, but we've lost so much money now, we have to sell. And your discipline tells you, once the stock's down 10%, or even better, you do it against the industry. Once my stock underperforms the industry by more than 10%, we got to sell it. We obviously messed up. Let's get out of the stock. Another sales discipline is usually a target price. I bought the stock at 80. I think it's worth 100 or 120. Once it hits 120, we're going to sell it. The problem with that is people say, well, now I think it's worth 130. So you want to be real strict on that sales discipline. You need to set it up. And the biggest thing you're battling is your ego. You got to make your sales discipline force you to admit you made a mistake and get out before it's too late. You just lose everything.
What about in a scenario where you buy an ETF? Would you sell it like that ETF underperforms the market by 10%?
Well, it depends about the ETFs. So if it's a passive ETF, then if you're betting that tech stocks are going to do well, then yeah, you have to say, I thought tech stocks are going to do well, and tech stocks are down 10% and market's up 10. Then yeah, you could set it that way. It depends on what your strategy is. So gets back to philosophy. I believe this, and now it's not working. So you got to admit, what did you do wrong? So Soros has this thing he calls his investment diary, where every time he does a trade, he writes about why he did it. So you say, I had a guy speak to my class a few semesters ago. I'm buying Apple right now because I think the market's wrong on their margins. The market is convinced the margins are going to shrink. I actually think the margins are going to widen. How is he going to know he's right or wrong? 6 months from now, their margins narrow. He's wrong, right? So he knows why he's wrong, or maybe their margins widen and the stock price comes down. Like, okay, well, I was right about the margins, but the market wasn't focused on that. So you document why you made the decision, and then you look and see what happened. So if you say I made a decision because of A, and B happens, the stock price goes up, you can't say, look how smart I was, because I expected A to happen and it didn't. B happened, so I was lucky, right? So you got to be really strict, and our egos hate that. What do our egos say? The stock price is up. What do our egos say? Look how smart I am. The stock price falls. What do we say? Oh, I was just unlucky. The market's stupid. We hate to say I was wrong or I was lucky. So that's what the risk management is all about, is to get that ego out of the decisions. So you make decisions based on the facts, not based on what makes you look smartest. All right, so try going through this. It's pretty tough to do, and be honest about it, but you should start now. Your interviews, they're not looking for you to have the next James Simons model. They don't expect you to know all that much because you're just starting out. What they want to know is that you're thinking about it, that you're passionate about it. And the number one thing they're looking for is curiosity, that you're in finance because you love finance. All right? They're not going to hire someone in finance that's already bored with finance. So the fact that you're doing this out of class, you're thinking about it, you got a brokerage account, you're on Bloomberg, that's what they're looking for. And say, hey, let me show you this model. I had one student in Brazil interviewing with the job, and he was interviewing the portfolio manager. He spent the whole interview debating his model with him. It's like, that's great. That's exactly what you want. And the portfolio manager's like, I don't think that's right. And all that. That's what you want. You want to be talking as if you're an investment professional and not like you're a college student. So get in this and do it. Don't try to do it right. Just do it. That's why I still say steal someone else's idea and go with it, just so you can start practicing and experiment with it. And then eventually you'll come up with your own style, your own ideas. All right, that's portfolio management. If you don't have money to start, then start with the paper portfolio and just start doing things, with fake money. All right, any questions on that? So start yesterday. So you're already too late, but start. The earlier you start, probably the overwhelming majority of undergraduate students don't do any of this. And it's kind of scary that finance students aren't involved in finance outside of class. So you got to somehow gets outside of the classroom. All right, we're going to really switch gears now and start talking about derivatives and really get into options. It's the last big question on the exam. Students have done pretty well on the question. The question is related to options, so we're going to focus more on options and on other derivatives. I'm a huge fan of derivatives. I use them a lot at UTSA. They're really, really wonderful things. There's only two types of derivatives, right? So a derivative is something that derives its value from something else. So an option is a derivative. You don't value an Apple option based on the option. You're valuing the option based on Apple's stock price, right? So this option is going to derive its value from Apple's stock price. Apple is going to derive its value from Apple. But an option on Apple is going to derive its value from Apple, from something else. It derives its value from something else. And there's only two types. There's options and futures. All right. Options include swaptions, insurance. Your auto insurance is an option. That right to prepay your mortgage early, remember that? We talked about that prepayment risk with mortgage-backed securities. That's an options. Futures include swaps, my favorite thing in the world, and forwards. So an option gives you the right to do something, but doesn't require you to do something. A future forces you, obligates you to buy or sell something in the future. All right, so those are the only two types. Hopefully you'll get exposure. Have y'all seen swaps yet? Have you in some classes? So I know Catapacman covers them. I cover them a little differently in my risk class. So Diego and Miranda have seen that. Did y'all had me and Catapacman? So I know I do it differently than him, but they're wonderful. I love swaps. As I tell my risk class, they're magical things. I'm not a forwards and futures guy at all. I just don't, my brain doesn't like them, but we're going to focus more on options. But the thing that they derive their value from is called the underlying, right? So if you're buying an option on Apple stock is the underlying, and the option is the security. Some derivatives are securities, they trade like stocks. And some derivatives are over the counter. They're not like securities. They trade between two sophisticated investors. So an option, you can trade options with your brokerage pretty easily. You can't do swaps or swaptions with your broker. That's going to be, over on the internet. You have to call up someone to do that trade, some investment banker. A derivative has a notional value. Notional values can be really, really confusing. If I buy $1 million of Apple, my market value is $1 million and my notional value is $1 million. So I own $1 million worth and my exposure is $1 million. So if Apple falls 10%, my market value falls 10% and my notional falls 10%. I lose 10%. Derivatives notional amount is not the same as market value. The notional amount is what your valuation is based on. It's what exposure you have. So your market value is going to change as if you had the notional invested, but you don't have the notional invested. All right. My biggest single option trade, my derivatives trade was a swap, interest rate swap. When you buy an interest rate swap, the market value is zero. It's worth zero when you buy it. That's the way they're set up. So I did like a $3 billion interest rate swap. The notional is $3 billion. What that means is the value of that swap is going to change as if I had $3 billion invested. So if the $3 billion falls 10%, my swap is now going to be worth negative $300 million. All right. The market value is going to change as if I had that $3 billion invested. All right. Notional amounts are massive numbers. So I love this website. You can look it up. It's called Visual Capitalist, all the world's money markets. I haven't linked in the notes, but what they do is they show you different things in the market, so in the world. So silver is, at the time they did this, I don't know when this was last updated. I think they update it every few years or so. Silver is worth $44 billion. Cryptocurrency, no telling what that was back then. 244 billion. Military spending, U.S. budget deficit, cash and banknotes, 6 trillion. The Fed's balance sheet, I don't know what that is today. Billionaires, if you took all their money, that's worth $8 trillion. Gold, that's worth 10 trillion. The S&P 500, Fortune 500 companies, they're worth whatever that number is. Stock markets, then NYSE, NASDAQ, that's worth $90 trillion. The money supply is $35 trillion. Global debt, we talk about the bond market being bigger than the stock market, 253 trillion. What have we not seen yet? What about real estate? Real estate, $280 trillion. Global wealth, 360 trillion. What have we not seen yet? Derivatives. The market value is 12 trillion. The notional value for derivatives is $558 trillion. It's more than the entire economy of the world. It's a massive, massive number. The media loves quoting this number because it's so massive, but it's somewhat of a nonsensical number. So if I do a $3 billion swap, my notional is $3 billion, but my market value was zero. Someone on the other side is doing a $3 billion swap as well. So it's like double counting, right? And if I do a $3 billion swap on something that has a 3-year duration, that's much less risky than a 10-year duration. So the notional amount's somewhat of a fictitious number, but it's massive. I mean, they're showing you the picture compared to everything else. I think they get up to even bigger number, whatever, the high-end estimate, 1 quadrillion. So we really don't know that number because it's just so massive. And the reason we don't know it is because swaps, forwards are over the counter. They're not reported to the press. We don't know what they are. So it's massive numbers. So really big numbers, but a little bit overstating the true risk of these things. And what can the underlying be? It can be a specific stock. It can be exchange traded funds. I'm going to show you some really crazy things you can do with exchange traded funds. It can be a stock index. You can do things on the S&P 500. You can do obviously forwards and futures on oil prices and other commodities. I did a lot of interest rate trades. You can do swaps and futures on interest rates. There are some derivatives on inflation. They're pretty thinly traded. Currencies is a massive one. There's a lot of currency trades, and then everything else. Did y'all know there's derivatives on weather? Swap on weather.
So like when you talk about trading small and trading different bets on that, what like brokerage is allow that? Because I know in Robinhood they use like a certain
Swaps, the trade swaps, you have to be pretty wealthy. I know some people with not a lot of wealth that their broker let them do swaps. You have to set it up specifically with them. I use an investment bankers like JP Morgan and Morgan Stanley. So I use them. It's tough. Swaps, if you take my risk class, I show them a swap contract. It's a massive contract. And if you don't have a lawyer And I showed my swap contract to my lawyers who had expertise in swaps, and they couldn't tell me what it meant. It was really frustrating. So well, I read a paragraph to them. I asked them, what does the paragraph mean? And I said, we don't know. So I thought this was your area of expertise. Said, yeah, but we don't know what that means because it was so confusing. And it was a standardized contract. It wasn't like it was JP Morgan's contract. It was the standardized contract. So swaps are tough. That's why they're over the counter, right? Whereas futures, your broker will probably allow you to do futures. So there's a lot of other, my P&C class, right? You're doing a paper on catastrophe derivatives, life insurance, social impact bonds. We're gotten really, really crazy. And ETFs, especially because there's so many bizarre ETFs, you can buy options on really bizarre ETFs. Well, I may show you some of those. Like your mind can't grasp it. It's just so complicated to think what you're actually doing with the derivative. There's plenty of places you can go. To CBOE is a great website. That's the Chicago Board of Option Exchange. They have a lot of training videos and all kinds of stuff, calculators that are good. The Khan Academy, amazing guy that, well, he does some really, if y'all use some of his stuff, really, really good videos. Amazon has a book called Option Strategies, Options as an Investment Strategy. I love this book, Trading Corporate Earnings. On corporate earnings news, that's an option book. The Options Guide is a website that's pretty good. There's podcasts out there. So whatever you want to do is out there. There's way too much out there. So you might want to just pick one, pick options, futures, pick something and just go with it and learn that one particular thing. So we're going to quickly cover futures real quickly because we don't really have time to cover futures. But a future contract obligates you to do something. So a future is just another way to buy something. I could buy oil today, or I could buy oil futures that delivers in 3 months. If I buy oil today, I'm out of cash today, and I got to store the oil somewhere. So if I don't need oil for 3 months, it's probably better to do oil futures. That way I'll lock in the price. I know exactly what I'm going to pay. But if I need oil today, you better buy oil today, right? So you have the spot market, the spot price. If you buy the today, then you have the futures price. What's the difference? The difference in those two should be cost of carry. So the spot price might be $100 for oil. The futures price might be 102. Why would you pay 102 when you buy 100? Well, if you buy 100 today, you're out $100, and you got to store the oil for 3 months. So you have a choice. You can buy oil for $100 a day, or you commit yourself to buy oil for 102 in 3 months when you need the oil. If you commit yourself in the future, you don't have to be out the cash and you don't have to store the oil. If it costs you $1.50 to store the oil and the time value money on the $100 is 50 cents, then you're kind of indifferent. You buy the oil today for $100, you store it for $1.50, you're out 50 cents on interest. Or you do the futures and you pay 102 in 3 months. So you see that you're indifferent. And that should be the difference between the spot and the futures price. That should be the difference. But it's not always the difference. The normal relationship's called contango. That's where the spot price is lower than the futures price because of that cost of storage, that cost of carry. But you can have backwardation. I think oil prices today are in backwardation, where the spot price is actually higher than the futures price. And that's probably because the oil market thinks OPEC's going to make a big decision here soon. So there's some speculation on that. That's possible. Now, if oil's in backwardation, why don't you just do an arbitrage? Why don't you sell oil today for $90 and commit to buy oil for $85 in 3 months? That'd be great. I'd ask any of you, how are you going to short oil today? How would you actually do that? You can short your neighbor's Apple stock, right? You can sell your the Apple stock of your neighbor today. You can short stocks. If your neighbor had some barrels of oil in his backyard, could you sell his oil? You couldn't do that, could you? You can't sell his house. So you actually can't do an arbitrage trade on this because you can't short an actual physical barrel of oil. Now you can do that with the S&P 500. The S&P 500, its spot price and future price is always going to be in line because that's an easy trade to do. You can't arbitrage that. But oil, And oil spends quite a bit of time in backwardation. It's not, it's not that uncommon, so. And I think it is now, although I haven't looked it up. I know it was a few days ago because The Economist had an article about that. So it is possible. But you got to be real careful. I hear a lot of people say oil is trading $100 a day. The futures price is 102. So the oil market expects oil prices to rise. That's not true. You always got to adjust for that carry. The carry should be in there. And then the expectation of markets is that amount around that. All right. So just because the future price is higher doesn't mean they're predicting higher prices. They're just putting in that cost of carry. I'm not going to cover this. I'll let y'all cover this. The only thing I'm showing here is buying oil today for $100 or using a futures contract. It's your gain or loss should be really, really, really simple, similar, because that future price is going to move with the spot price of oil. It's going to be a very simple, similar trade. So buying oil today for $100 or doing the futures contract is essentially the same trade. You're essentially betting on oil prices rising. So that's all this is showing you. So we're not going to do all the rest of this. The difference between futures and a forward, futures are securities and traded on public markets. Forwards are over the counter. They're between sophisticated, usually with a investment banker. It creates counterparty risk because you're dealing with one party. If they go under, you can lose a lot of money. Most futures contracts settle in cash, not in physical delivery. And you better make sure if you do futures, you realize that if you don't want 100 barrels of oil showing up in your doorstep. So usually what happens if you do oil futures and oil prices rise, you made all this money, you'll sell the future before expiration, get your cash that way. You're not going to wait to the very, very bitter end. All right, that's all I'm going to do on futures because I want to really get into the options. How much more do you need on futures? Well, that could be your entire career. Spend, the next 50 years of your career doing futures.
Yeah, we can overtrade futures.
Huh?
By any chance, if you know, she could be overtrade futures.
Oh, yeah, you can. Yeah, I know Ameritrade was letting people do futures. Yeah. And you can real life trade them too. I know people with that much money doing futures. I mean, you better know what you're doing because your losses could be massive. Remember, your market value when you buy futures is zero. So it's kind of deceiving. When I did my first swap at USAA, the poor accountant's like, what do we do? The market value is zero. How do we do a journal entry for zero? And yet 3 seconds later, it had a value, right? I could look at it, and that swap was one of my biggest trades. It was worth $516 million a couple of years later. That's a pretty good trade, right? You spend zero and it's worth $500 million. But the accountants are going to have to do something with $500 million, don't you think? You got to make some entries. So it was confusing to them. They had to get their FAS 133 to figure out what accounting do I do for this strange thing. So it can be really deceiving because futures and swaps have a zero market value at execution, and then the price starts changing immediately. And so the accountants have to figure out how to account for that. So if you do a future, you might think there's nothing there, but boy, if you have $1 million notional, and the thing moves 10%, you just lost or gained $100,000 just like that. So you got to be really, really careful. All right. So we're going to spend a lot of time here on options. So options is a right to buy something that's called a call, or the right to sell something that's called a put in some future at some expiration date at some stated price. So does that right have any value in and of itself? So we go on to Yahoo Finance. We look at, let's look at NVIDIA since they're, well, let's look at Tesla. And here it is right here, options. And we'll go out to say August. So Tesla today, you can buy for $142 a day. And I'll give you a call option, gives you the right to buy Tesla for $150 the next 3 months. Would that be worth anything? You can buy for $142 today. Would me giving you the option to buy for $150 be worth anything, you think? In 3 months? What if I said in the next 10 minutes? hey, I'll let you buy Tesla for, well, the market's closed. So tomorrow, between tomorrow, today and tomorrow, 8:05 a.m., you can buy Tesla for 150. Would that be worth anything to you? Would you pay a penny for that? What about in August? How much would you pay for that? Any guesses? Because what could Tesla stock do in the next 3 months? It could jump to 170. Then wouldn't it be look good to buy for 150? So how much would you pay? Give me a guess. What would you pay today for an option to buy Tesla for 150? 10 cents, $10, $100 per share.
Per share.
Forget the times 100. No guesses? How about $15? So let's say you pay $15 and in 3 months, there's the stock is trading for $155. Did you make a good decision?
Yeah. But, well,
You paid 15 bucks. Now the stock's worth 155. You can buy for 150. So how did you do?
you did good.
Did you do good or not? You made $5 on the option, but what did you pay for the option? 15. So you lost 10 bucks. What if it's trading for 200 bucks? You could just sell it for 200. You bought it for 150. You made 50 bucks, but how much did you pay for that? 15. How did it come up with that 15 bucks? We'll talk about that. What drives that value? You notice what happens as your strike price gets higher? What's happening to that call option? It's cheaper, right? 200 bucks. What's the chance Tesla will be worth 200 bucks in the next 3 months where people are willing to spend $3 to do that? Huh?
So does that also, does like people selling their own options also affect like the price of per share? Like on an option, for example, like when you.
Like supply and demand?
You buy them in.
Well, and you can't look, I've had options where it said 3 contracts and now I had 3 contracts. So, I mean, there can be some bid ask risk with that, but options, if it's I just happen to have a execution that just wasn't that popular, but yeah, I probably got hurt a little bit, but yeah, if it's a fairly liquid underlying stock, you'll probably be okay. But yeah, I mean, you can see here, there's not many. In some places, 7. But does it look like it's out of line? It looks pretty well in line, doesn't it? What if I gave you the right to sell Tesla for 120 bucks? Does that have value in the next 3 months? It's been falling 40%, right? You may be worried. Say, hey, I think they're gonna keep falling. How much would you pay for that? 120 bucks? Well, that's the puts. Boy. So here's the puts. I didn't see going into the puts. How much would you pay for that? $8. So if it falls to 130, you'll make 10 bucks on the put, but you lost $8 buying the put, so you've only made $2. Where did the puts stop? I didn't see them. There they are. I just missed that entirely. So the option to do something that has value, even if I said you can buy Tesla for 150 bucks tomorrow, you may only be willing to pay a penny for that, but it still has some value. I mean, it's possible they have some major announcement tonight and the stock just shoots up tomorrow. I mean, that's certainly possible. We're working toward this. So we're going to talk about calls, puts, protected puts, covered calls, collars, and straddles, strangles. So those are the only ones we're going to cover. There's a lot more than that. Don't tell people we're pricing options because we're not. So we're focusing on expiration date, which is much simpler. So option pricing, Black-Scholes, binomial models, that's something you'll have to take in this speculative markets class. So we're doing everything at expiration. It's amazing. The video I do for the exam is my most watched video. People just think it's amazing and it's really, really quite simple. So we're going to be using one formula over and over again. Sometimes it's S minus X, sometimes it's X minus S, depending whether it's a put or a call. So we're working for this. We'll come back to this. We can look at it. But we're looking at options. Really, really powerful tool. Gives you the right, not the obligation, but the right to buy something or the right to sell something. So a call and a put. That's within some future date, and there's a lot of dates you can pick. There's something called the option chain, which has all of the strike prices, all the dates. So we have an expiration day, we have a strike price. And it has value. Anytime you give someone an option to do something, it has value. The question is, how much are you willing to pay for it? Options have a high probability of loss. This is the nature of how they're priced. The majority of time, you're going to lose money on an option, which kind of implies you should be selling options. And people do sell options. There are some strategies out there that are people believe are better than buying the stock market, that you can have higher returns if you do it. We'll talk about using calls and puts to actually execute a trade in a more efficient way. But they're heavily skewed distributions. I've had options up literally 40,000% in 2 days just because something moves. They can move a lot. 40,000 doesn't sound like much, but if you spent $2, 40,000%, you go from $2 to several $1,000.
When a company gives their employees stock options.
Well, it's similar. It's just they're not publicly traded, so they have restrictions. Management has restricted options. We had people coming to USA as executives that had options, and we had to somehow let them know, here's USA's bonus system versus your option system. His outlook. I had to use Black-Scholes to kind of figure out how much those options were worth. But it's not for the faint of heart. I mean, these are things where you can lose a lot of money really fast. So
At USAA, were y'all exercising the contracts or playing premium?
no, you almost never exercise. Yeah, almost never. In fact, the only time you exercise is if you forget you have one and you forget to shut it down. I've gone to the very last Friday. They expire on Saturday. So you go to the very last, so you can still trade even on expiration day. And they trade off of open, but open's not the open you see online. There's a different open that's more official. But yeah, you can trade even in the very, very last days. So, but it's really dangerous to do that. I did it once and learned my lesson. But all right. So an option can be in the money or out of the money or at the money. In the money for a call means the stock is trading more than the strike price. So you have the right to buy a stock for $100 and it's currently trading for $120. That's in the money. That's a great option. It has what we call intrinsic value. If the current price is greater than the strike for a put, that's out of the money. The right to sell something for 100 when it's currently trading for 120, that has no intrinsic value. It has nothing but what we call time value. So that's out of the money. If the strike price is higher than the current price for a call, that's out of the money. All of that option value is what we call time value. There's no intrinsic value. All right, we'll talk about intrinsic value because we're going to be using the formula for intrinsic value over and over again. If the strike price is greater than the current price for a put, that's good, right? You can sell it for 120 and it's for 120, it's currently trading for 100. That's good. That's in the money. And at the money, it's really hard to find anything at the money. Because stock trade for $112.13. There's not going to be any strike price at that. So at the money is not all that common. It happens every once in a while. To show you put call parity, I'd have to find an option right at the money, and that's just almost impossible to do. If I can find one, I'll let you know. I'll look for one. So here's ones we're going to do. We're going to start with what's called a long call, which a long call just means you buy a call. That's a bullish strategy. You're hoping the price goes up. So look at this formula because this is the formula that's missing a parentheses, but this is the formula we're going to use. This is the value of an option at expiration. It's the max of the stock price minus the strike price and zero. Why? Because if the stock's worth 90 and the strike is 100, you're not going to buy the stock. You're not going to spend $100 for something worth 90. So you'll just let it expire worthless. So the worst you can do is zero. But if the stock's trading for 110 and the strike is 100, then you'll execute, make $10. So the max of those two minus the cost of the call. That's going to be your gain at expiration. The intrinsic value, put this in your notes. The intrinsic value is this part of the equation. That is the intrinsic value. And that's true all the time, not just at expiration. The intrinsic value is the max of the stock price minus the strike, comma zero. That's always the intrinsic value. A put, you notice with the put, all you got to do is switch the two things. It's X minus S. Why? Because with put, you're selling, you're not buying. right? So that's pretty critical. We'll talk about put call parity. I love put call parity. But we can combine calls and puts. We can go long and short. We can mix strikes. We can hold the underlying. We can hold Apple stock and own a put option. We can own Apple stock and sell a call option. There's a lot of different strategies. Have y'all heard of put call parity? It's a magical thing. So what does put call parity say? It says at expiration, or even at any time, a call plus a bond, we'll talk about that bond, has to equal the put plus the stock. That is the price of the call plus, so what is DK? DK is the present value of the strike price. All right, so if the strike price is $100 and it's 3 months out, what's the present value of $100? That's what the DK is. That's like a bond using the risk-free rate. Should equal the price of a put plus the stock price. If those two do not equal, you have an arbitrage opportunity that you can make money. How often do they equal? They're going to equal almost all the time. Hedge funds may be playing in this game, but you as a small investor, you'll never make money doing this because you'll get crushed on the bid ask. But this is not a theory. This is a truism. If you can do this for $100 and this is $110, then you sell that for 110, you buy this for 100 and you know you just made $10 without any risk, right? But how often is that going to exist? So I'll try to show you put call parity, but I have to find an option that's right at the money. A couple of semesters ago, Nike was trading exactly like a round number, like 90. So I could actually show you put call parity, but it's tough to do it because it's hard to find stocks that are right at a strike price. But you can look up put call parity, but you can actually move this around. So a call is buying a put, buying the stock, and borrowing the strike at the risk-free rate. It's exactly that. A stock, look at a stock. Let's say you can't buy the stock for some reason. What could you do? You could sell a put option, buy a call option, and buy a bond that matures at the strike, and it'd be exactly the same thing as buying the stock. So that's put call parity. This is called, another word for this is replication. Have you ever heard replication before? So you can look up replication on Google. But replication says is you want to buy A, but you can't buy it. But if you combine B, C, and D, it's the exact same thing as A. So you're going to replicate A by using B, C, and D. So put call parity is one of the most famous replications there is out there. And Wikipedia does a great job on put call parity. So you can look it up and see it. It's a great theory.
You can do this also if you want to change like the duration of your portfolio too, right?
I'm sorry?
You can do this also if you want to change like the duration of your portfolio, kind of. If you want to like sell puts, buy calls.
The duration like a bond portfolio or?
Well, like your weighted average of your portfolio. You know what I mean?
No, not like you said duration. I'm not sure.
I'll give that to you.
Yeah, I'm not real sure. I mean, you can certainly radically change the risk profile of your portfolio. And we'll talk about, if you have a stock you don't like, but you don't want to sell it for tax reasons, you can certainly use these to pretend to sell. I mean, essentially sell the stock without selling it. I mean, there's things you can do using options to do some things, but they are pretty expensive. So you gotta be careful, you know what you're doing, that you're not getting ripped off. So these are the ones we're going to focus in on. So the best way we can do this is just get in Excel and do it. So we'll start off with a long call option. So why don't we do Tesla, since they're kind of exciting this week. Really great market today, right? 0.2%. So here's Tesla. Their stock is up a lot because they released earnings. And 5 days, I mean, you can kind of tell where they released earnings, can't you? It's kind of obvious. So we're gonna go over to options, and let's say, well, let's look back at this chart. So they've been as high, you know, they've been, well, even recently, they've been over 250. They've been as low as 147. Is it possible, and that was just a few months ago, they were 250 something. So you're trying to think, you know, what I think Tesla might do if they get some good news, because they flipped back up to 250. They came down from 250 to 150 pretty fast. So let's try Tesla. We're going to do a call. So we need a strike price. So their current price is 162. And I'm just going to say 162 so we don't have to do a lot of decimals here. Let's try a strike price, say, of 210. All right. Then we need a maturity expiration. Now, if we do an expiration April, what's the chances they're going to be at 210 in April? Not likely. So how far out do we go? Let's see what options we have with our options. So the option chain is every strike at every date. And if you go to CBOE, they'll give you the entire option chain. I mean, it takes lines and lines and lines. Now, people like to do like historical analysis on options is really tough to do. Because you don't, it's not like one stock, you know, Apple stock, you can go get their price every day for the last whatever years. With options, you have like, well, which strike and which maturity? So you have multiple choices, but let's go out, say, to September. So we're doing call options. Is this in the money or out of the money? The right to buy Tesla for 210 bucks, and we can currently buy from 162. Out of the money, all right? So anybody know what the intrinsic value is? It should take you less than a second to calculate it. You don't have to do any math. What's the intrinsic value? Zero. Zero, right? If it's out of the money, the intrinsic value is zero, which means this option is going to be 100% time value. All right, so we're going to go out to September. And then we have the premium. Any guesses what this premium is going to be? $2, $5, $8, 10. Let's go out to 210. All right, we've got 3 prices. This price is completely unreliable. That is the last price. Why is that unreliable? So when I started doing options at USAA in our mutual funds, I was watching my mutual fund value at the end of the day, and I would call up the accountant and say, there's no way that's right. And they were using last price. So you can't use last price. If the last price was at 1 p.m. and the market closes at 3, option prices move a bunch. So we had to change their process not to use last price, but to do end of day bid and ask. All right. So the bid and ask is what's important. So the last price just means, you know, especially if there's only a few trader, you know, if there's not many trades, there's a good chance that that last price it could even be a few days old, but it could be several hours old. With options, because they change so much, you need to use the bid ask. All right. So here, this column shows you the bid and the ask. The bid is going to be the lower number. The ask is going to be the higher number. You can kind of guess which do you think you're going to pay if you're buying something. 720, right? You have to pay the ask. What are you going to get if you're selling the option? Get the bid. So this is the spread, the bid ask spread. So 720 is what we'll have. On the exam, I'll give you both the bid and the ask. You'll know if you're selling something to use the bid, if you're buying something to use the ask, but it's pretty obvious. If you're buying something, you know you're going to pay the higher price. So it's not like you have to memorize those. All right. So the intrinsic value. The intrinsic value is always this formula. It's the max for us for a call, the stock price minus the strike price and 0. So here, 162 minus 210, what's the max of that in 0? 0. So what's the time value? The time value is the premium minus the intrinsic value. So what's the time value here? It'll be 720. Right, so if an option's out of the money, its entire option premium is time value. What does time value do as you approach expiration? It goes to zero, but not in a straight line. So usually what happens with option premiums is it kind of declines slowly, and in the last 30 days it shoots down. So if you're going to roll this over, you're going to want to sell this option 30 days before it expires. Camille?
Yes, sir. Oh, would you mind backing up to your C6? Can you explain how you, yeah.
Yes, so that's just a definition of intrinsic value. So here it's max 162 minus 210 and 0. And what does that equal? It's
What
gonna
is the dead zero?
Well, it's the max of this, which is what? Negative 48, 38, 48. What's higher, negative 48 or 0?
Zero.
0. So it's the max of those two.
Okay.
All right. And so what we're going to do is we're going to go at expiration. Let's say at expiration, Tesla's trading for $100 or $110 or $300. All right. Let's do that. What if Tesla's trading at these values? So what is the gain on the stock? Well, the gain on stock's pretty easy. The gain in stock is it's worth 100 and you bought it for 162. So you would have lost $62. That's pretty straightforward. And this is just going to be a straight line. If it rises to 170, you bought it for 162, it's worth 170, you made $8. That's pretty easy. It's just a straight line. So what about the gain on the call? Well, the gain on the call is not intrinsic value. So this is intrinsic value. So be real careful. Intrinsic value equals max S minus X comma 0. The gain at expiration equals max S minus X 0 minus what you paid for the call. All right. That's at expiration. Before expiration is not true because you have time value. So there's going to be some adjustment. So the gain on the call is going to be equal max the stock price minus the strike price, which was 210 and 0. What is that going to give me? You can buy the stock for $210. It's trading for $100. You're going to execute that call?
No.
No, you're gonna let it expire worthless, 0. But how much did you pay for the call? $7.20. So what's gonna happen if the stock price falls? You lose $7.20. At what point do you start making money? So if it goes to 210, you can buy for 210, or you can buy for 210. How much is the option worth there? Nothing. So you lost $7.20. What if it goes to 215? You made $5, but you paid $7.20. So what did you do? Lost $2.20. What's the break even you think it's gonna be? 217.20, right? You'll make exactly 0 there, right? So what is the break even? It's going to equal the stock price minus, it's going to be the strike plus the call premium. So in this case, it's going to be 210 plus 720. So if the stock gets to 217.20, you start making money. You'll still execute at 212 to get at least 2 of your dollars back, or you might execute, you'll trade it. So if it goes to 212, you don't say, well, I lost money, just forget about it. You're still gonna get that $2 to reduce your 720 loss, but that is the break even.
What determines how long you wait?
Well, there's a lot of philosophies. So when we did at USA, anytime we bought an option, we'd usually sell it and buy a new one 30 days before it expired. We sold an option, we're going to expiration. We want to get all of that because all that time value is ours. And so when you sell an option, you love time value because you get to keep it all. But if you're buying an option, time value kills you, especially in those last 30 days.
You know the formula for, gain on the call?
The what?
Gain on call.
Yeah, the gain on the call is exactly the same. It's essentially intrinsic value minus what you paid for the call. It's the same formula. You'll see I'm using that formula over and over and over again. Max S minus X comma 0. That's intrinsic value. That minus what you paid for the call is what you're going to make or lose at expiration. So if we graph these two things, this is a straight line. Nothing interesting about that. That's just a straight line. But is the call a straight line or not? If I tell you that the call looks like a sport apparatus, what sport would I be talking about? Not football. I don't know if you mean soccer or American football, but it's not like a field goal. So we don't play it in Texas much. They love it in Canada though. So what does this look like? A hockey stick, right? Does that look like a hockey? Well, it's kind of a strange hockey stick, but so for the put, the most you can lose is that $7 for the call, excuse me, the most you can lose is that $7.20. But at some point, you start getting that back, and at 217.20, you start going up and having a larger gain. Present labels coming up. There it is. So most you lose is the option premium. They must say, well, I made more money with the stock, but you didn't really, right? Because of the stock, you had to pay 162 to get this gain. For this gain, so it's true, you paid 162 and you made $100. That's kind of nice. Here you only made $50, but how much did you pay to get that $50? You only paid $7.20, which has the higher percentage return. Call option by far, right? $7.20 and you make $50 versus you pay $162 and you make $100. Call options have a much, much, much higher return. Down here, it doesn't look so bad, but how much did you lose on the call option here? You lost $7.20, but you also lost 100%, right? So the option, you lose 100%, but you also make much, much higher returns on the upside. So this is a Tesla call option. I remember this shape because when we were talking about put call parity, what else is a call option? We should get the exact same shape if we buy the stock and buy a put. That's called a protected put. We're going to do protected puts. You're going to notice that a protected put looks like the exact same hockey stick as the call option. So buying a call option is essentially the same as buying the stock plus a put. It's very, very similar. So we'll see that. You'll see it when we do the picture. Right, so there's a long call. Let's do a long put. Let's do Tesla again. So Tesla got down to 141. A lot of headwinds, a lot of things going on, and then a strong reaction to this earnings report. You're thinking, I think the market's overreacting to this earnings report. If Tesla starts selling these cheap cars, it's going to destroy their whole brand. There's no way they're going to compete with China. They need to be the Ferrari of the EV. They can't try to compete with, because China's cars are so much cheaper, pretty decent quality. I think they're gonna be destroyed in that strategy, all right? I'm not saying that's true because I don't know enough about Tesla to know. But you could argue that, and eventually the market's gonna figure that out in the next couple of weeks, that, they overreacted this earnings report. I think it's gonna fall back down below 150. So I'm gonna do a put option with a strike of 150. So it's trading for 162. We're gonna do a put strike 150. So is it in the money or out of the money? You can sell it for 150 bucks, but it's worth 162. So the way you figure out if it's in or out of money, if you ask, would I do that trade today? Would you sell something for 150 that you could sell for 162? You wouldn't. So is it's out of the money? What's its intrinsic value? 0, right? All right. Expiration, let's stick with that. And then the premium. You got to go all the way down to the puts, way down at the bottom. So 150. Again, we're going to be paying the ask price because we're buying the put. So that's 13.25. What's the time value on this option? Your time value is the option premium minus the intrinsic value. You just told me intrinsic value was 0. So what's the time value on this option? 13.25. All right. So let's do Tesla. I'm going to cheat and just copy it from here. Y'all can't do that in your notes, but I'm just going to copy it over. So here, stock gain, the same as before. It's worth 100 bucks. You bought it for 162. So again, that same straight line. The put gain. So it's the exact same question, but you flip. You flip the S and the X. So here it's going to be max of X minus S and 0 minus the premium. Put premium. All right, you switch them because you're selling it instead of buying it. So here we do equal max. Now, what do you think here? You can sell this stock for 150 and it's currently trading for 100. Does that sound good? Are you glad you did this? That sounds pretty good, doesn't it? So the strike is 150, trading for 100. So you just made 50 bucks there, but what did you have to do to get it? You had to spend 13 bucks. What's the most you can lose on this transaction? 13.25, right? What do you think the break even is here? And don't say 163.25. Go the other direction. What's the break even here?
37.
Yeah, you have to go down, right? $136 maybe. So 136, why? Because it has the fall to 150, but then it has the fall another 13.25 to get your option premium back. So once you hit 136.75, you break even. After that, you start making money. Now, what sport apparatus is this going to look? Oh, I got an error somewhere in my formula. What did I don't know why. E4 minus E4 minus A16. Oh, I forgot the 0. Okay. Yeah, Bill Gates is like, hey man, you're missing something. All right, so what sports apparatus is it going to look like? The same thing. right? It's another hockey stick. It's a little upside down. It's another hockey stick. So maybe if you look at it sideways, it would work as a hockey stick. We need to do all this stuff Bill Gates should have done for me automatically, but so here, if the stock price falls, you make money. So that's why this is a bearish strategy. But the most you can lose is this. This is your car insurance, right? If you pay your car insurance, most of the time, what do? You just lose money. But if the price of your car drops dramatically because you crashed, what happens? You start making money on the car insurance. Now you can buy a put option on Tesla without owning Tesla. You can't do your car insurance like that, right? I want to buy car insurance on my neighbor's car. So if he wrecks it, I want to be paid money. Your insurance company's not going to let you do that. So the insurance company requires you to own the underlying and to pay the premium. But you could just do this with Tesla. You think they're going to fall. The most you can lose is the premium, which is pretty substantial here, $13.25. That would be a pretty big drop. But you could make $50 off of that $13. So that's a pretty hefty return. Right, pretty straightforward. So where can we go next? So let's look at these first. So we're going to start with a protected put. Protected puts, popular one. On a protected put, you'll just have to know this for the exam. There's no notes, you have to do it. But these are the most basic ones that you should just know as a finance major. So protected put, you're going to own the stock and own the put. All right, so you own two things. You own the stock and you own the put. All right. A covered call, so you own the stock and you sell a call. All right, we'll talk about that. That's one of the ones we're going to actually sell something. A straddle, you don't own the stock, you own a call and you own a put. Same thing with the strangle. Straddle and strangle are essentially the same thing. With a collar, we did a lot of collars at USAA. Is you're essentially combining the protected put and the covered call. So you own the stock, you own a put, and you sell a call. Those are ones we're going to do on the exam. On the exam, I don't know which one of those I'm going to give you. I'm going to give you one of them. You'll just have to know which one to do. So on the exam, you have to do a long call, a long put, one of these strategies, and then calculate time value. That's the entire question. We'll do some practice next week, definitely. We can't really do spreads on the exam. It gets a little tricky, but spreads is when you're mixing strike prices. Like at USAA, we did put spreads. So I had a put so that I was long a put with an expiration with a strike of 1,000, and I sold a put with a strike of 500 or something like that. So that's the spread. Or you can do spreads on dates. You own a put that matures in 3 months, and you're short a put that matures in 4 months, something like that. All right, we're not going to do spreads in here, but spreads are interesting. What else is there? I can't, if you force me to name every option strategy, and you got condors and butterflies and strategies. There's just so many of them. Let me find something that's not a commercial. Here's 10 that everyone should know, right? You should know these. Covered call, that's one of ours, right? So they're saying you should know that one. What do they mean by the naked call? Anybody know that? Sounds obscene, but is that obscene? What does naked call mean? So naked call, anytime you say the word naked, you're selling something, which means you have incredible risk. If you sell something, you have almost unlimited loss. So if I sell a call option on Tesla and its stock price goes up, I'm in a lot of trouble, right? I can lose a lot. So naked call, that's when you're selling something. So a covered call, you're selling the call, but you also have the stock underlying stocks. Well, that's not as dangerous. A married put is a very, very strange comment. So that's very similar to what we're going to talk about. A spread, this looks an awful lot like a covered call. So some of these strategies, we're going to create almost, this is essentially what a covered call looks like. But they're doing a spread. Bear put spread, that's another kind of covered call backwards. Protective collar, you see how the collar looks a lot like that? That's where that put call parity comes in. They're essentially recreating the same thing, but just with different securities. A straddle, we're going to do straddles. We're probably going to do strangles. Straddles are really, really tough because everything has to be right at the money. And to be right at the money, your strike price and the stock price have to be the same. You notice Tesla's trading from 162, but there's no 162 strike. So you really technically can't do a straddle. You'd have to do a strangle. But that looks like a letter in the alphabet, right? So a strangle looks real similar, right? The strangle, the closer you get to being at the money, the more it starts looking like a V. So strangle and straddle, there's no reason to learn those as two different things. Then you have these things. I know some people who love these. So essentially what this is doing is saying, I want to sell options because I make a lot of money, but when you sell options, you got a lot of risk. So I'm going to cut off the tails. So I can make a lot of money, but the stock really, really moves. I limit how much I lose. All right. We're not going to do butterflies, but it sounds cool, right? Condors, essentially it's the butterfly with just different shapes. Then iron, and the iron butterfly looks like what? Looks like a butterfly. So, they're getting creative. What else is there? It's ridiculous. If you go on Bloomberg has a really, really good function. It's called OMON, and they'll let you try all kinds of strategies. And there, it's really pretty cool. I think you can have up to 10 positions. So if you want to buy the stock, sell a call, buy another call, buy another put, sell a put, well, all different expirations, you can do all kinds of things. And they'll model it for you. What happens to stock price does this, they'll model all that for you. So I think these are the ones you should know coming out of this class. And you notice with some of them, they look real similar to other strategies. So looks like there's more strategies than really are just because of that put call parity. All right, so let's go to the first one, protected put. Pretty straightforward strategy. So protected put, you own the underlying and you own a put, usually out of the money. You could be in the money or at the money, but that'd be kind of strange. So usually you own the stock and you have a put option on it. So let's use Tesla. So when would you do a protected put? You want some of the upside, you think they're going to go up, but you think there's a risk they could really fall. So essentially you want to buy insurance in case the stock price really falls, but if it keeps going up, at least you still have some of the upside. So Tesla's trading for 162. We're going to do a put option with a strike of 150. Expiration September. And the premium we already know, right? 13.25. I'm using all the same data as over here. And essentially what I did here, I could just copy this over and I would have it. Because what is the protected put? It's just the sum of these two columns. That's all it is. All right, I'll recreate it so we can get some practice. So Tesla at expiration. The stock gain is just going to be the current price minus what you paid for it. Same thing we had before. So you can see once you learn to put, doing the protected put, there's nothing new here. You just got to just do the put again. Someone tell me the formula for the put gain. Equal max. This is a put. Strike minus P, all right? Which part of this is the intrinsic value? Yeah, so this is the intrinsic value. The intrinsic value is what you get at expiration. That's the expiration. Because why? Because the time value goes to 0. All you're left with is intrinsic value. So we do equal max, the strike, minus the stock, comma 0. I'll remember to do this time, minus 1325. Now, so the protected put is you just add those two together. You still lose money, but the interesting thing is how much will you lose here? The same thing. How much will you lose here? The same thing. Same thing. So the protected put gives you a max loss. The most you can look, what if this stock goes to 20 cents? What are you going to get? Any guesses? 25. All right. The most you can lose is, isn't it kind of nice going in? You say, hey, the worst case scenario, you'll lose $25.25. Doesn't matter what Tesla does. You could go out of business. You make 25.
So essentially, we're betting on Tesla. There you go.
Well, you're more so here with the long put, because here, this is all you have is the orange line. All right. Here, you notice you have, well, let's go all the way down. Here, you notice you have a whole lot more upside. What was your upside on the long put? There wasn't any. You lose 13.25. But here, you make more, but you lose your 13.25, but at least you have some upside. So here, you're a little bit more bullish, but you're still worried about the downside, right? So here, what I want to do, so I can graph it, I'm going to bring this over just so I can graph. And what is this going to look like? What call parity? I just told you a few minutes ago. This is going to look a lot like what? Any guesses? It's another hockey stick, but what hockey stick is going to look like? It's going to look like this hockey stick, the call, or this hockey stick, the put. It's going to look exactly like the call. You almost won't even be able to tell the difference. Right? It's that hockey stick. I have the amounts of it different. All right, let me. Sorry. Bill Gates. He should know what I want to do. But I wish I could change the default to put labels low. I've never had a situation where I didn't want labels low. So it looks an awful lot like buying the call option. It's not exactly the same because remember you have that present value of the strike, you have that bond part that's going to give you a little bit of difference. But mathematically, they're practically the same. And this is kind of nice, right? You have some upside. So you have a couple of choices. If you're worried about the downside of a Tesla, you could just buy a call option on Tesla. Because the stock price goes up, you gain, but if it falls, you just walk away and lose your $7.20. You don't have to worry about losing $62. And this is what you might do if you don't own Tesla and you want to get in, you just buy the call option. Protected put is you already own Tesla, but you're worried about it's falling, and this is where you go out and buy the put option, protect the downside. So it's essentially buying that insurance because now you're worried. Why wouldn't you just sell Tesla if you're worried about it? Well, you think there is some upside. Also, if you sell it, you may have some tax gains that you don't want. So protected put allows you to, hey, stay in the stock, protect the downside, and then you still have a lot of the upside. If you know Tesla's going up, would you do the protected put? No, you just have Tesla, right? Because you get all the gain, but at least you get some of the upside potential. Okay. All right, so
Scroll back up. Please.
to where?
Can you scroll back up?
So you see, we didn't do anything different. Here. It's exactly the same thing. The gain on the put is exactly the same as we had before. Only difference is we're going to add the stock and the put together to get us our protected put. Questions on protected put? They're pretty popular, pretty simple. They're also ridiculously expensive. So
What's the third column? We have all.
I'm just bringing this over for the graph. So it's the same. I just need to be able to do the graph. I might be able to move it now. We'll see what Bill Gates does. Yeah, that was fine. That worked. All right, protected put, pretty popular. Have y'all heard protected put before? Pretty popular strategy. All right, now let's do one of my least favorite, but I'll talk about when it makes there. I do think there's a time for covered call. All right, so covered call is you own the stock and you're going to sell an out of the money call. Right? And you see the picture, you can say, why would anyone ever do that? You know, I'll talk about when you would do that. It does make some sense. So we got a call option. Strike is, what do we say, 210? Expiration. Premium. So here we can't use that $7.20, can we? Because we're selling the option. Oh, you remember it. Ah, that sounds right. Was it 705? That sounds right. I can't remember 3 seconds after I get it, but so it's yeah, 705. So you're gonna sell it, but unfortunately you're gonna get 17 cents less because your broker or trader or whoever has got to make some money off of this. All right. So let's do Tesla expiration. Now here, do you want the stock price to go up or go down? The answer is no. This is a kind of a strange strategy. Let's take the stock gain, the same as we said before, the ending value minus what we paid for it. The call gain. All right, so here's really, really critical here. The formula is exactly the same. So for a call option, how do we do it? Max of what? An X, comma 0, then what? It's the same formula, except for here we're selling a call option. So what do we need to do? The exact same formula, and then just change the sign. All right? So pretty simple. So it's exact, so you don't have to learn anything new, exact same formula. The only change you have to make is use the bid instead of the ask. All right, but use the same formula because you're selling the option, you change the sign. All right, everybody see that? So here I can do minus max. Stock price is 100 minus the strike, comma 0 minus the premium, and make sure the entire formula is minus. All right, not just the first part. So I'm really doing minus. You'll see that minus 705. I mean, minus 705. Why? Because I'm receiving the 705. That's mine. I get to keep that no matter what. right? So here, what are you gonna get if it falls $100? 705, right? That looks, whoops, something, what did I leave out here? I did something wrong.
You need to make the.
Oh, yeah, okay. All right, so I'll make some, that sounds really good, right? That's a lot better than I had with my my put. Then the stock price goes up. Oh, no. The stock price goes up. Now I'm losing money. The nice thing is, though, you notice as your call losses are going up, what else is going up? Your stock gains. So those are going to offset each other. So what's the covered call gain? You're going to be plus the stock, plus the short call. And I already showed you the picture for this. It's a bizarre looking picture. You might ask, why wouldn't anyone ever do this? That's not, yeah. So why would you ever do this strategy? You have all this downside, and on the upside, you're capped. You can't do any better. That sounds pretty bad, doesn't it? Let me see if I can graph it next to the stock price so you can see. So if you fall, you lose, but you don't lose as much, right? You get $7.05 helping you. But if the stock price goes up, you're out. You're happier here, right? You're happier, but are you happy? You lost a lot of money. I mean, you say, "Hey, boss, I lost $50, but I could have lost $57." So just to let you know, good news. Boss is like, "Yeah, your idea of good news is not all that great." All right, so let me put some. Let me put the stock price in here. So why would you ever do this strategy? So this is the time I would do this strategy.
Think that it's not gonna go up that much.
Well, I'm even more precise, but you're getting to the right thing. Let's say your target price is 210. So you're telling your boss, hey, if Tesla hits 210, we're selling. Well, if you do this strategy, you can sell it today for 210. If you do that, you get to $7.05. All right, so you have two choices. You can do nothing today. When it hits 210, you sell it at 210. What do you get if that happens? You make a $48 gain. What if instead of waiting to hit 210, you go ahead and sell the call option today? Then when it hits 210, you can't make any more, but you did better. You're $7.05 off. So which would you rather do? Have a $48 gain or $55.05 gain? You're the same way. If it's gonna hit 210, you're the same, but the call option. So what this is a way for you to execute your target price today and make an extra $7. That makes sense to me. All right. So yeah, so Carlos, to your point, I think it's going to 210. But if I thought it was going to fall, I probably wouldn't do this. I'd probably do the put or get out of it. But I'm pretty confident it's going to rise, but I don't think it's going to rise more than 210. That's when it makes sense. So you're really precise. So if you have target prices, I mean, it's pretty cool, right? You can execute that target price today. What if it never makes it to 210? Only goes to 200. Are you glad you sold the call option? Yeah, you're $7 better off. What if it only goes to 190? You're still $7 better off. When's the only time you're worse off? Well, if it closes at 208 on one day and opens the next day at 230, then you're kind of upset, right?
So like when option traders use algorithms for certain like technical analysis strategies.
I'm sure there's hedge funds that are doing this. you're gonna find that options don't offer many obvious strategies. They're priced incredibly efficiently. I used to drive my core option trader at Credit Suisse. That doesn't exist anymore. I would call him with these strategies. I was looking and he would off top of his say, yeah, you're not thinking about it right. He was so much smarter than I was on these. But he had everything set up on the computer. He could look at it and I would say it and I go, never mind. I see what I'm thinking wrong. But I was learning options pretty quickly because we're doing some pretty massive transactions. And fortunately, this guy named Stu, he's from San Antonio. I wish I could get him to come back here and speak because he's option guru. When he left Credit Suisse, I was in so much trouble because his replacement didn't have the knowledge he did. I love talking to the guy. So smart. But you think you got to say, hey, Mom, this really strategy really looks good. And he'll say, yeah, but you're forgetting this and this and this. So options are pretty tough. You learn them by just experimenting. You just got to play around with them. You're rarely going to find an obvious transaction that's going to be the perfect solution for anything. All right, so there's a cover call. It doesn't look all that great because you have all this downside. You're limiting your upside, but it allows you to enhance your return to do something you were going to do anyway and pick an extra $7.
And so when you sell it, someone on the other end has to buy the contract.
Yeah. I mean, they trade very efficiently.
And the people, is there a scenario where you don't get your contract bought back?
It's a very liquid market. I've had times where there's only 2 outstanding contracts and I'm both of those 2 outstanding contracts and I got a perfectly fine price on the other side. Yeah. I mean, that's,
Oh, just for clarity, which side, which is the upside and which is the downside? Because I think I might be confused.
well, this orange is you own the stock and you sold the call. So you have all of the downside and you're losing all the upside. The blue is the stock itself. So you have all the downside of the stock, except for you can make an extra $7, but you don't get the upside of the stock. That's the upside. So this you're pretty upset. But if you're going to sell it at 210 anyway, at least you made an extra $7. It's not a strategy I think is all that great, but it's a perfectly good strategy. There are some people. I mean, there's a lot of strategies out there. There's some people who say my target price is 140. How could you execute that today? It's trading for 162. You can't buy a call option at 140. That'd be way too expensive. You don't want to buy a put option, but what could you do? How could you buy a stock at 140 today and pick up an option premium in case it never falls? Any guesses on that? This is, you're saying one of the right words in the wrong direction, but can't use a call. So what else are you left with? A put, but you can't buy a put. So what are you left with? You could sell a put strike 140. What happens if it goes down to 140? You sold the put, you now have that stock at 140. What else do you have? You got the option premium. So if you say, hey, we're gonna buy Target at or we're gonna buy Tesla at 140, why wait for it to hit 140? Sell a put option today with a strike of 140. If it falls to 140, you now have Tesla at 140 because the option is going to force you to do that. But if it never hits 140, you're still happy because you got the option premium, right? So that's a very, very popular. In fact, I was watching, I can't remember if it was Baylor or West Texas A&M, when they did their portfolio competition, they do that strategy all the time. Rather than buying the stock, because the stock is 162, we don't want Tesla. We want it at 140. But if you want it at 140, you're really not taking any risk. You want it at 140, you sell the put option with strike 140. You're going to get it at 140. That's what you wanted. Your only big risk is if they get some major out of left field news, and instead of going to 140, it drops down to like $50 or something, then you're in trouble. But I mean, if you're really confident you want Tesla at 140, this is the way to do it and pick up extra income. So it's very, very popular strategy.
What is that called?
Well, it's just a naked put. I don't know if the strategy itself has a word.
The stocks have to make it-
No, you don't own the stock. Here, you want to own the stock at 140. But rather than waiting for it to go to 140 to buy it, you don't own it. You just sell the put option today.
Okay.
So when it hits 140, you essentially then have the stock.
But in the original scenario, when we first started, it's another call.
Right.
That's okay, that's not.
Yeah, I'm talking, so a covered call is a good way to sell the stock at your target price and get that extra premium and do it today. You don't have to wait for it to hit 210. A naked put is the way to buy the stock at your target price and not wait for it to fall that low and you get the premium. So you see how the market likes to take advantage of that time value premium and you get to keep it and it's all yours. So options are cool things. There's some ways to do this. Now you have to talk to your broker to let you go do naked options because that's pretty risky to them. And I'll just give you a little trick. When you fill out the form for your broker, make sure you tell them that you're an aggressive seeking upside. You can't say you're conservative. I used to put that we were conservative because we're using options to protect ourselves on the downside. And they wouldn't let me do options because they say you're conservative. So no, I'm conservative because I'm buying protected puts. So I had to just say, no, I'm out there to make money. That's what I'm out. I'm aggressive. And then they let me do the options. So be careful how you answer those questions because they won't let you do certain trade. They assume any option trade is speculative. And a lot of option trades are not speculative. They're actually risk reducers, but brokers just don't understand that. Let's see how we are here so far. All right, intrinsic value for a call equal. Someone tell me that formula.
Equal to max. X minus X. Zero.
All right, and the gain on a call. Same thing again, right? There you go. A put. Just flip them, right? So easy. Same thing here. Right? It's just really not that complicated at all. This is not option pricing. This is intrinsic value. And we're doing an expiration. Option pricing, you have to bring that time value in. That's where it gets tricky. What about a protected put? What do you own? What do you short? What do you buy? But not the formula. Just tell me what you own. Own the stock. So let's say long the stock. Long a put. All right. Covered call. Short call. Is that a naked call?
No.
No, because you own the stock, right? Because the call is dangerous, the stock price goes up, but you own the stock. So at some point, they're just going to offset each other. All right. The next one we're going to do is a collar. Well, a collar is long the stock, long a put, and short the call. That's the one we saw the picture for earlier. So you're essentially combining a protected put and the call. And then the last one we have is I'm going to say strangle. They're long a call, long a put, no underlying stock. All right, those are the ones we're going to do. These formulas are all you need. The only thing you have to know is if you're buying something, use the ask. If you're selling something, use the bid. So you can see this question is not that complicated. Not a difficult question. Most students get the put and call right on the exam. When it gets down to whether it's protected put or covered call, some students get mixed up there. And then the other thing I ask you to do is calculate time value. Time value, so easy, equals the premium minus the intrinsic value. So this formula you've already used, you just take what is the premium, you subtract that intrinsic value, and that's your time value. If it's out of the money, the time value is going to be equal to the premium because there is no time intrinsic value. If it's in the money, some of it's gonna be time value, some of it's gonna be intrinsic value.
Sir, just for clarity, so cover call, you own the stock, so you put long stock and for protected put and cover call, what are you saying when you say long stock?
You own the stock for the call.
Is that what long stock means?
Yeah, long means you own it, short means you shorted it, you sold it. Right, so we own the stock, we own the put, and we sold the call option. All right,
So, for this long put is when you're selling it. So what does long put mean?
well, long put means you're buying the put.
Oh, okay.
I mean, it is bearish, but you're buying the put because you own the put. You're not selling the put. Selling the put would be, you know, kind of a naked transaction probably. It'd be strange to sell the put and own the stock. That'd be like you're doubling down on this stock,
Long put, you own.
right? So those are the ones we have left. I know y'all are leaving noises, but I want to real quickly give you this. That time value, how do you figure out that time value of the stocks? So there's 6 inputs to the price of an option. And we use the acronym Texas Video. All right, let's see if y'all can guess these without looking. T is not for Texas, T is for time. X, strike. So it depends on if you're a bowler or a baseball player. Some people use what for strike? Some people use K. So if you go to Investopedia or Wikipedia, I think they use Ks. I use X's, not because I bowl. I don't bowl anymore. But I don't play baseball anymore either. So I'm used to strike being X, but if you're a bowler, use an X. If you're a baseball player, use a K. S, the underline, just like we're doing. V, the most important one of all. That's volatility. How volatile is that underlying stock? The more volatile it is, the more valuable the option is. I, probably the least important one. It's more important today than it was in 2020. Interest rates. And then D, do they pay dividends or not? All right, so those are the inputs. What you need to know, we're not going to do it on the exam. What you need to know is if time increases, how does that impact the value of option? The more time, the more valuable call option is. The more time, the more valuable put option is. If the strike price is higher, that makes the put more valuable, the call less valuable. If the stock price is higher, that makes the call more valuable, the put less valuable. So X and S go in opposite directions. Volatility, the more volatile the stock is, the more valuable the put and call are. Interest rates, I'm not going to push them so much. That really has to do with the time value. What options allow you to do is instead of buying the stock today, you can do it in the future. So a call kind of likes interest rates. It kind of makes it cheaper for you. A put kind of dislikes it. So, and then dividend, because dividends, when they pay, they cause the stock price to come down. It hurts your calls, helps your puts. So those are the inputs. If you use the CBOE's calculator, those are all the inputs you have to put in. They ask for all those inputs and you get option price. There's only one of these inputs we don't know when we enter an option. Which is that? Volatility, because this is not the historical volatility, it's the volatility going forward. All right. What do you think volatility does if the stock's reporting earnings tomorrow? Shoot up, right? So volatility is much higher around earnings. All right, I'll stop it there.